Hello everyone, welcome back. This video covers lecture 2 of BFC 1010 or BFC 1010, however you want to say it. Remember, you should be purchasing or should have purchased Accounting Fundamentals for non-accounting students from FunSkykes. In video 1, lecture 1, I welcomed you all to BFC. You're going to enjoy this year and you're going to learn quite a bit about accounting for a sole proprietor. We looked at ethics, accounting terminology, and I'm busy working through chapter 1 of this textbook. I've already covered quite a few terms, accounting terms already. You can go and check video 1 again. You can have a look for the link. It's on my YouTube channel. The module guide has been sent out there. When we face to face, we can have a look at that again. Now, ethics in your life, workplace, and accounting, we looked at that in the last video, and I made a specific reference to a good work ethic because you're going to need to work consistently. I'm saying this again. You need to stay motivated. You need to manage your time well, and you put in some real effort in order to do this module wholeheartedly. And remember to complete the tasks that you're given. They are very important. The more you get into this subject, the more you're going to enjoy it. Work. I discussed the good workplace ethic. Not going to go through that again. And then good accounting ethics, honesty, accuracy, transparency. All the information needs to be trustworthy so decisions can be made responsibly. Let's say by management or the owner, those people who are involved in the planning of the business. Right, and then I asked during lectures, just remain silent. There will be a time to ask questions. We want everybody to remain focused. You need to pay careful attention. Don't be inconsiderate to the person next to you and disrupt them. You're paying money for this content and knowledge. If you're late for class, enter the class at the back and be seated at the back. We, the lecturers, are here to play our part. You need to play your part. At the end of the day, you write the exam. What you put in is what you're going to get out. Right, now we're going to carry on with accounting definitions from chapter 1 of your textbook. We looked at what is accounting. It's a system where all information, financial information, transactions are recorded, and that information, all those recorded transactions provide useful information, and it's used by people, managers, owners, investors, banks, suppliers, the stakeholders of the business. And so accounting will help you make informed decisions, economic decisions. You can also see if the business is profitable from the financial statements, if the business is stable, or if the business is worth investing in. So accounting is a system, the double entry system. For every debit there's a credit, where the bookkeeper records all the transactions of the business, produces financial statements, and then management, owners, the stakeholders use that information to make decisions. Right, what is an entity? Now, an entity is any independent unit, such as a person, business, or organization, whose financial activities are recorded separately for accounting purposes. So an entity, like our case study, Calibu Education, it's a separate legal entity or a separate entity, and it makes use of an accounting software package called Zoho to record the financial records. These days there are many accounting software packages that come for free, and this one is a good package, Zoho Accounting. It comes for free, and the reason you are studying accounting, it enables you to understand any software that is out there. So it is important that you do learn about the basics of accounting to understand the software that you're going to use one day, whatever software it is. Right, entities, they can either be a service concern or a retail trading concern. Service concern means you deliver a service, like a lawnmower service or a hairdresser. You don't sell a physical product, but you render a service. So your entity could be a service concern. We will deal with service concerns and trading concerns. A trading concern or retailer means you buy physical products, you buy stock, and you sell the stock. You put a markup on and you sell that stock. So there's the definition of an entity. An entity is any independent unit, such as a person, business, or organization whose financial activities are recorded separately for accounting purposes. Like Calibu records all their financial activity in an accounting software package called Zoho. You can actually go onto the Zoho website and set up, believe it or not, your own business, because remember that that accounting software is for free. Now, I mentioned a trading concern will buy goods and sell goods at a markup in order to make a profit. Goods, stock, and inventory are different words which mean the same. A shop will buy goods to sell. A shop will buy stock to sell. A shop will buy trading inventory to sell. The best word in software, or the word that is used in accounting software, is trading inventory. So trading inventory is stock or goods. And in fact, trading inventory can be called merchandise as well. So if we were looking at Calibu, those are just three digital products, videos on certain topics. So the stock or the inventory for Calibu is actual videos. Right, and there's that word I just used for goods, merchandise. It's called trading inventory. Inventory is the collection of goods a business owns and intends to sell, including items ready for sale and those still being produced. So if you have a manufacturing concern, the unfinished goods could be counted in the value of stock. Okay, there's our case study, Calibu, selling accounting courses or videos. So the stock is, in this case, digital products. So trading inventory are the items that you sell, that your shop sells, buys and sells. What is a service? So say, for example, Calibu offers online education. These are topics that are covered and the prices. Those are examples of a service, not selling a physical product, but rather a lesson. A hairdresser renders a service. They cut the hair of a client. That is a service concern. So we're going to be looking at trading concerns and service concerns. A business can actually do both. A hairdresser might sell a whole lot of shampoos, products for your hair, as well as style your hair or cut your hair, which is a service. Right, what is historical cost? The historical cost price is the original purchase price excluding VAT. So a trading concern will buy, let's say for example, stock at cost price. The business will add a markup or gross profit and sell the item at the selling price. But cost price is the original price of an item that a business pays. For example, Calibre Education purchased this vehicle. What was the cost price, the historical cost price of the vehicle? For example, 165,000 Rand, and that amount excludes VAT. That is the historical cost price of this asset. All items are recorded at the historical cost price, the original price. Right, the selling price, the sales price. The sales price is the amount a business charges a customer for a product. So you're actually going to have the cost price plus the markup is equal to the selling price. So sale of digital products, there would be a catalog, selling prices of these videos, and once again these are videos, digital videos being sold to the public. So selling price is the price that is charged to the customer. And I mentioned this earlier. You've got the selling price minus the cost price. That will give you the markup, and another word for markup is gross profit. So a retailer will buy stock at cost price, add a markup, cost price plus markup is equal to selling price. But more about that a little bit later. And then of course you might have to include VAT on the selling price. Right, assets equals owner's equity plus liabilities. This is the accounting equation. I might elaborate a little bit more on this. I'm sure I will when we meet face to face, and so will the other lecturers. But let's have a look at this. Okay, let me just play around here. The owner is worth, owner's equity, the owner's worth is equal to the value of the assets minus the total liabilities. Now if I played around with this equation, if I get assets to be on its own, I would take the liabilities across, and it would be owner's equity plus liability is equal to assets. Now if I've gone through that too quickly, don't worry, we will go through that again. That is how this equation is derived. Assets equals owner's equity plus liabilities, and that is actually the format of a statement of financial position. But for now, you just need to know A is equal to O plus L, the accounting equation. Every single transaction will have an effect on the accounting equation. This here is a list of common assets that we find in business. And you get non-current assets and current assets. Long-term or fixed assets like land and buildings, machinery, equipment, furniture, vehicles. Long-term investments, for example, a fixed deposit. Current assets, trading inventory, debtors, bank, petty cash, cash flow and input. This slide is very important. Under owner's equity, you're going to have capital and drawings. You're going to have income. Capital affects owner's equity, what the owner puts in. Drawings affects owner's equity, what the owner takes out. That's why it is under owner's equity. And under assets is non-current and current. You can pause this video and have a look at all these items that are listed under these different elements of the accounting equation. In your textbook, you will also see a page that has this information listed. So under owner's equity, you're also going to have expenses. So you got capital, drawings, income and expenses. This is a list of expenses. When we do transactions, it will help to know what are assets, what is income, what are expenses, and also liabilities. Long-term liabilities, a long-term loan, and a mortgage loan. Mortgage loan is a loan that you've taken in order to buy property. A long-term loan could be a loan in order to expand your business. So you get non-current liabilities and current liabilities. Current liabilities, for example, creditors, suppliers from whom you've bought on credit. A bank overdraft, more about that later, is a current liability. Then two adjustments that we do at the end of the year. Income received in advance and accrued expenses are liabilities. So this is a great list of all the different elements within accounting, within the accounting equation. Very important slide. And there's a dice, and the dice will help you remember. Under owner's equity is D. Beneath here there was I for income, C for capital, and E for expense. Dice. Drawings, income, capital, expenses. Those four items, elements, classifications, whatever you want to call them, affect owner's equity. This year is the accounting cycle which we will work through during the course of the year. In business, transactions take place in order to make a profit. So the owner will transact wisely in order to make a profit. Every single transaction will be recorded on a source document. Receipts, invoices, debit notes, credit notes, statements, EFT confirmation slip, right? The source documents will be used to record the information in journals, cash book receipts or cash receipts journal, cash payments journal, debtors journal. This can be called a sales journal, a debtors journal. It's for credit sales. A creditor's journal or a purchaser's journal for credit purchases. General journal, petty cash journal, allowance journals. We will work through them at a later stage. For now, you just need to know transactions take place. Transactions are recorded on source documents. The source documents are used to journalize all the transactions. From the journals, the information is taken to the ledgers. The general ledger on a monthly basis, and accounts receivable, debtors ledger, and accounts payable on a daily basis, where a record is kept of individual debtors and individual creditors. Then on a monthly basis, a bank reconciliation will take place, a creditors reconciliation, a debtors reconciliation. We will look at a bank reconciliation. Then at the end of the month, after the general ledger has been drawn up with all the accounts in the general ledger, a trial balance is drawn up. A trial balance can be used for a number of purposes: to check your accuracy of recording your transactions, whether your debits equal your credits. Now this happens for 12 months. What's in grey happens for 12 months. Then at the end of the year, adjustments will be done. Right towards the end of RFC 1012, we will do adjustments. And eventually, we will do financial statements. Okay, there's a statement of profit and loss, that's an income statement, and a statement of financial position. Then the information in the statements will be analyzed and interpreted. So this here is the accounting cycle, what happens on a monthly basis and what happens at the end of the year. We will concentrate in the next few months on the grey blocks, and we will get to the orange blocks and the red blocks in the second semester. Remember, RFC 1011 must be passed in order to do second semester. RFC 1012. And I might be giving you information you don't need because you're BFC 1010. I apologize for that. You need to know the accounting cycle. Don't stress. Right, transactions. A transaction is any financial event that changes a business's assets, liabilities, or owner's equity. I did mention that earlier. The accounting equation is affected by transactions. Financial event, a transaction. And all transactions must be recorded in the books of the business, the accounting records. These are examples of transactions: a capital contribution, a cash purchase of stock, the purchase of equipment, credit sales, an insurance claim, the owner withdrew petty cash, a supplier was paid, we received the bank statement, and on the bank statement were bank charges. These are examples of transactions, and at a later stage you will learn how to record these transactions. All transactions are recorded on a source document. So a source document is the original written or electronic record that provides proof of a financial transaction, proof that the transaction took place, such as an invoice, receipt, or bank statement. Here is an example of a credit note. The credit note was issued by Calibu Education. The credit was given to the school. The school is a client of Calibu Education, and there is the amount. But more about these documents and this type of transaction as we move on in the course. All you need to know right now is all transactions are recorded on a source document. In this case here, the duplicate was kept to record the financial information. Calibu sent this original document to the school and kept the duplicate to record the transaction. Source documents continued. Here is an invoice, a tax invoice. This tax invoice was given from the computer store to Calibu Education because Calibu Education purchased tablets and accounting software from the computer store on credit. Right, an invoice is on credit. If it was a cash invoice, it would say cash. And by the way, Calibu needs to pay the supplier. They've agreed upon terms of settlement. It says there 30 days. So Calibu Education has 30 days to pay the computer store for the tablets and the software. If they don't make it on time, they might be charged interest by the computer store. That's another transaction. Right, and the original document from the computer store is used by Calibu Education to record this transaction. Right, documents continued. So in your textbook you will see documents are listed: receipts, till slips, credit invoices for sales, credit note duplicates, debit note, credit invoice. You can stop the video and see what these documents are used to record. For example, a receipt is proof of payment. So if a customer paid cash to Calibu Education, Calibu Education would issue a receipt and keep the duplicate to record the transaction. We will look at these documents in more detail as we move on. Right, subsidiary journals. Now, subsidiary journals are the journals I've already pointed out. For example, a debtors journal, which is a sales journal. This whole journal records credit sales. The debtors journal or sales journal is an example of a subsidiary journal. And remember, there was the cash book receipts, the cash book payments, the petty cash journal, the debtors journal, the debtors allowance journal, the creditors journal, the creditors allowance journal, and the general journal. And there, pause the video, the journals I've just mentioned are listed. Another journal. All items that are purchased using the petty cash, staff refreshments, postage and stationery, go through a petty cash journal. More about the journals in due course. Right, what is petty cash? It's cash that is used for small payments. If you need to go and buy tea and milk for some people that are coming to see you, a client, you can take petty cash and buy these small items that are needed. I just put this in here. This is an example of a general journal. The format or the layout is different to the other journals. You're going to look at the account that is debited and the account that is credited. But this here is a general journal. All those transactions that do not fit into the other journals will go into the general journal. The general ledger. From the journals, we take the information and we put it into the accounts in the general ledger. So a general ledger is the central accounting record where all businesses' financial transactions are summarized and organized into individual accounts. That there is an example of a general ledger. There's an account, interest on current account, the telephone account, the wages. And we will learn why an account is debited and why an account is credited. Debited, right hand side. Credited, left hand side. We will learn about these accounts. What is an account? An account in accounting is a structured record used to track all increases and decreases in these items: assets, liabilities, equity, income, and expenses. We will see accounts. I will show you an account in a moment. And the account I've just used to demonstrate the definition of an account. In the general ledger, we have all the accounts. Here we have the equipment account. Now the equipment account is an asset. We've learned that already. And on the debit side of equipment, I'll give you a quick example. An increase in the value of an asset, this is a rule, will result in an entry on the debit side. We will learn the rules. So the equipment on the 1st of January was worth $210,000. We got rid of a piece of equipment that had original historical cost of $90,000. More about these accounts later. What does debit mean in accounting? Now we got the general ledger of Calibu. I've taken the bank account, and on the left hand side it is the debit side. I divided this account. If you've ever heard the term T account, that's where the T comes from. On the left hand side there are columns for date, details, folio, amount. And on the right hand side exactly the same. Columns for date, details, folio, amount. But the left hand side is the debit side and the right hand side is the credit side. Now you might wonder, why is that abbreviation DR? I'm going to tell you. It comes from a Latin word called debitera, and the abbreviation for debitera is DR. You would think when you heard the word debit that it would be DT, but now that you understand that it came from another language, that's how it ended up DR. And the same with CR. You would think it would be CT, credit, but it comes from a Latin word, creditera. That's just a bit of trivia. The left hand side is DR and the right hand side is CR. And there I got that to expand. The debit side is the left hand side. And the credit side, CR, and I've used the capital account. The credit side is the right hand side. And you will see for every single transaction, the value of the debits will equal the value of the credits. After this next slide, I'm going to stop because I'm giving you a lot of information. But remember, you're reading through the textbook and you're covering this work. And you can watch a video over and over. The accounting terminology is important as it is the foundation of your future accounting. You need to know why an account is debited and why an account is credited, but we will deal with that when we do the accounting rules. The last thing I'm going to end on in this video is the principle of double entry. Now, the principle of double entry, that is the accounting system we are working with, means that it states that every transaction affects at least 2 accounts, ensuring that the total debits always equal the total credits. Sometimes 3 accounts are affected from a transaction, or even 4, but the debits will always equal the credits. I'm going to show you one quick transaction. Richard also made a cash contribution of 20,000. Richard is the owner, so he made a capital contribution of 20,000. According to the accounting rules, the capital account gets credited with 20,000. The bookkeeper of the business opens a bank account and puts the money into the business bank account. Now look at that. In these 2 accounts, the debit equals the credit. 20,000, 20,000. When we do transactions, you are going to learn which accounts are involved and why an account is debited and why an account is credited. And if you know that, your trial balance and your balance sheet will always balance if you apply the rules correctly. Right, that's it for today. We've been going for 37 minutes. Remember, you need to also complete the register. Once you have watched this video, you fill in the document with your name. You click on the link that is in the email where you picked this up from, and you fill in the document saying that you've watched lecture 2, and you submit that document, and us lecturers will then know that in inverted commas you've come to class, this virtual online class, and management wants that information, so you need to complete that registration when you've watched this video. Once again, we look forward to seeing you in class. Chat soon. Cheers. Bye.